180 is the market's hardline question. Is this repeatable or was it luck? Intraday, CRDO, Credo Technology Group Holding Limited trades around 180, down about 5 from the prior close near 190 after opening around 187. The day's range is already wide, roughly 178 to 189. That spread is the cost of uncertainty, charged in real time. Nobody is denying Credo's recent results. The market is deciding whether those results mark a new stable baseline or the peak of a temporary spike. On December 1st, 2025, Credo reported fiscal year 2026 second quarter results for the quarter ended November 2025. Rounded for readability, revenue was about $270 million, up about 270 year over year and up about 20 sequentially. Gross margin was about 68 on both GAAP and non-GAAP measures. GAAP net income was about $80 million, non-GAAP net income about $130 million, and non-GAAP diluted EPS about 0.70. Cash and short-term investments were about $810 million. Those numbers usually calm investors. In a high multiple stock, they can provoke doubt because they raise expectations and reduce tolerance for even a small miss. That's where valuation becomes the invisible force. At around 180, Credo carries a trailing PE around 160 and a forward PE around 54. High multiples behave like forward contracts. Investors pay today for a future slope. If the market revises the probability of sustained hypergrowth and high margins downward, even slightly, multiples compress and price drops fast, even if the business remains strong. This is why a stock can slide intraday after blockbuster fundamentals. The past is not being rejected. The future is being repriced. To understand what the market is really debating, you need to understand Credo's operating role in AI infrastructure. Credo sells high-speed data center connectivity, interconnect, the layer moving data between GPUs, servers, racks, and switches. As AI clusters scale, bottlenecks often migrate from compute to communication. Inefficient interconnect wastes expensive accelerator time, burns more power, generates more heat, and reduces utilization. That makes connectivity a direct lever on the unit economics of AI. Credo's portfolio maps to the physics. Active electrical cables, AECs like Highwire, are active because they include electronics that condition and equalize signals over copper links, extending reliable reach and improving performance at high speed. Optical PAM4 DSPs use digital signal processing to correct fragile high-speed optical signaling. PAM4 increases throughput by using 4 signal levels instead of 2, but it reduces noise margin, making correction more critical. PFI solutions operate at the physical layer, translating digital data into real-world signaling while fighting jitter, crosstalk, and distortion. SerDes, serializer, and deserializer converts wide parallel data into fast serial streams and reconstructs it. It is foundational to modern high-speed I/O. SerDes chiplets are modular dies integrated into larger systems, while SerDes IP is licensable design logic embedded into other companies' silicon. In short, Credo sells the plumbing that determines whether AI infrastructure runs efficiently or wastes money. So the bull case is coherent. Interconnect is a structural bottleneck, and spending must rise as AI scales. The mystery is whether Credo's demand is broad and durable or concentrated and lumpy. Here's what normal looks like when growth is durable. Demand broadens across multiple customers and products. Sequential growth stays strong across several quarters, and visibility improves because programs diversify and become more predictable. The less normal pattern is concentration. 1 or 2 hyperscale ramps, 1 platform transition, 1 product wave. That can create explosive year-over-year growth, but it can also decelerate abruptly when procurement cadence changes, inventory digests, or architectures shift. Both patterns can produce a blowout quarter. Only the broad pattern supports an expensive multiple through volatility. That's why 270 year-over-year growth triggers 2 reactions at once: excitement and suspicion. It is not that the numbers are fake, it is that the slope may be harder to repeat than the market price implies. 2 additional contextual factors raise the discount rate investors apply. First, Credo is NASDAQ listed but domiciled in the Cayman Islands. Many firms use offshore domiciles without incident, but it changes the legal wrapper and governance expectations. In a moderately valued stock, this is background. In a stock priced for perfection, it becomes part of the risk premium. Second, on September 29, 2025, Credo completed the acquisition of Hyperloom, described as developing micro-LED-based optical interconnect technology for chip-to-chip communications. In the normal acquisition playbook, investors want clear integration milestones, roadmap fit, sampling timelines, commercialization path. A strategic, longer-dated deal can be visionary, but it expands execution variables. Under high valuation, more variables typically means higher volatility. Now, translate all of this into what investors can act on: levels. Around 180, prices near the session's low, around 178. The 189 to 190 zone, anchored by the intraday high and the prior close, is first resistance. If price cannot reclaim 189 to 190, rallies are likely to be sold into. If 178 to 180 breaks decisively, the market is signaling it wants a lower entry price to carry the same story. If you own CRDO, the emotional trap is anger. How can this be down after that quarter? The disciplined answer is that the stock trades the next several quarters, not the last one. If you don't own it, the trap is paralysis. The 52-week range, from roughly 30 to roughly 214, shows how violently the stock can move, and high valuation amplifies downside when certainty fades. So treat this as a managed mystery. Hypothesis 1. Demand is broad-based and Credo's connectivity stack is sticky across multiple programs. If true, earnings can keep scaling, the premium can be defended, and a future retest near 214 is plausible. Hypothesis 2. Demand is concentrated in a few ramps. If true, the business may remain strong, but the stock remains volatile because procurement cadence shifts can reprice the future quickly. Hypothesis 3. Fundamentals are strong, but valuation outran visibility. If true, expect extended chop until repeated quarters compress uncertainty. Short term, respect 178.78 to 180 as support and 189 to 190 as resistance. Stabilize and you can justify a tactical entry with tight risk control. Break support and fail to recover, and capital preservation is rational. Medium term, reclaim and hold above 190 and the path opens toward 200 and potentially a retest near 214. But the normal pattern after a sharp peak is volatility and multiple attempts, not a smooth climb. Long term, the bet is structural interconnect demand plus continued differentiation and execution. The quarter ended November 1st, 2025 and reported on December 1st, 2025 is strong evidence. The valuation requires repeated evidence. And if you are tracking names like this, drop a comment with the tickers you want covered next. Valuester is actively looking for listener tips on public stocks, private companies, and even names that are expected to list, plus coin projects you think deserve a serious narrative-driven teardown. Tell me what you are watching and why, and what detail you want investigated. Also, to everyone who keeps coming back, who subscribes, hits like, comments, and shares these episodes outside the platform, thank you. That support is the difference between a one-off episode and a channel that can keep raising the bar. I will repay it with sharper research, tighter storytelling, and better content. That is what 180 means. The market is not denying Credo's past. It is demanding proof about Credo's future. This was Valuester.